In March of the year 2000, Cisco Systems was the most valuable company on Earth. $555 billion. The picks and shovels of the Internet. Every hedge fund manager on Wall Street swore the chart had nowhere to go but up. 18 months later, the stock was down 86%. And here's the part that should make every NVIDIA shareholder very, very uncomfortable. 26 years later, in 2026, Cisco's stock has still never recovered to its 2000 high. Now, look at NVIDIA. $5.4 trillion. Picks and shovels of artificial intelligence. Every hedge fund manager on Wall Street swears the chart has nowhere to go but up. If your stomach just dropped a little, good. You're paying attention. This is Rich Owl, where we break down the stories Wall Street would rather you not think too hard about. Today's story is the one nobody on financial YouTube is willing to tell you about the most loved stock in the world. Because the math doesn't care about your portfolio, and the math is starting to look an awful lot like 1999. I'm going to walk you through 3 things in the next 11 minutes. First, why NVIDIA in 2026 is the most precise rerun of Cisco in 2000 we have ever seen. Second, the $725 billion money loop that is quietly propping up the entire AI economy. And third, the exact trigger that ends this rally. One phone call that collapses $1.5 trillion of market cap in 90 days. None of this is conspiracy theory. All of it is in the public filings. In 1999, Cisco made the routers and the switches that everyone needed to build the Internet. Every telecom company on the planet was buying Cisco gear as fast as the factory could ship it. Revenue was growing 55% year over year. The CEO, John Chambers, told investors the company would grow at 30 to 50% a year, basically forever. The stock traded at a price-to-earnings ratio of 200. 200. For context, the average S&P 500 company trades at about 20. People justified it the same way they justify NVIDIA today. The infrastructure of the future. Picks and shovels. Network effects. This time is different. Sound familiar? The telecom companies buying Cisco gear were funding it with debt. Cheap debt. WorldCom, Global Crossing, Nortel. Borrowing billions to build fiber networks that wouldn't be used for another decade. When the credit window slammed shut in 2001, the orders stopped overnight. Cisco's revenue didn't slowly decline. It fell off a cliff. The stock dropped from $80 to $10 in less than 2 years. Cisco wasn't making routers for end users. Cisco was making routers for companies that were spending more than they earned on the bet that future revenue would justify it. When the bet failed, the orders evaporated. Now look at NVIDIA's customer list. 4 customers, Microsoft, Meta, Amazon, and Google, generate roughly 40% of NVIDIA's data center revenue. That is the most concentrated revenue base of any trillion-dollar company in history. And what are those 4 customers doing? They are spending $725 billion in 2026 alone on AI infrastructure. That number is up 77% from 2025. Sound familiar? Cisco's customers were funding their buying spree with debt. NVIDIA's customers are funding theirs with their own earnings, for now. But the actual AI revenue they're generating from all of this is roughly $50 billion. $50 billion in revenue against $725 billion in capex. That is a 7% return on infrastructure that goes obsolete in 3 years. No business on Earth can sustain that math. None. This is where it gets really uncomfortable. Stay with me. Once you see this, you can't unsee it. NVIDIA does not just sell chips to Microsoft, Google, Amazon, and Meta. NVIDIA also invests in the AI startups that those hyperscalers are renting their AI capacity to. OpenAI, CoreWeave, xAI, Anthropic, Mistral. NVIDIA puts money into the AI companies. Those AI companies use the money to rent compute from Microsoft or Amazon. Microsoft and Amazon use that rental income to buy more NVIDIA chips. NVIDIA reports the chip sales as revenue. The market sees the revenue, bids up the stock. Higher stock price justifies more capex. And on it goes. This is not a conspiracy theory. This is in NVIDIA's own 10K. They disclose the equity stakes, the customer concentration, and the revenue from related parties. It's just that nobody on financial television wants to talk about what those three disclosures look like on the same page. They look like a closed loop, a self-licking ice cream cone. The technical term in accounting is circular revenue. Same dollar passes through three balance sheets, shows up as revenue on all three of them. As long as the loop keeps spinning, the stock keeps going up. The moment one node pauses, the whole structure has to mark itself to a new reality. The new reality is that underlying AI revenue is $50 billion, not 725. There's a second problem with the math that almost nobody is talking about. NVIDIA's Blackwell chips, the ones hyperscalers are buying right now at $60,000 apiece, are about to be made obsolete by NVIDIA's own next-generation chip. Vera Rubin NVL72 delivers 5 times the inference performance at 1/10 the cost per token. Every Blackwell chip Microsoft paid $60,000 for is worth 10% of what it was last quarter. NVIDIA's own roadmap is destroying the depreciation schedule of NVIDIA's own customers. If you're a hyperscaler CFO, why would you sign a billion-dollar Blackwell order today when Vera Rubin ships in 8 months? You wouldn't. The moment one CFO decides to wait, the 2026 capex becomes 2027's problem. NVIDIA's revenue doesn't have to fall. It just has to stop growing at 77%. Let me show you the trigger. It is one phone call. One hyperscaler CFO tells their NVIDIA account exec their 2027 order is being cut by 20%. Not canceled, just cut. Because NVIDIA's stock is priced for unbounded growth. 40 PE, 5.4 trillion market cap. Wells Fargo just raised the price target to 315. If one customer cuts 20%, the model breaks. Other hyperscalers immediately do the same. They have to. Here's the part nobody's talking about. The insiders already see it. Jensen Huang has sold over $1 billion of NVIDIA stock in the last 12 months. The board has collectively dumped more than $4 billion. Insiders do not sell at the top of a 30-year secular trend. They sell when the next 18 months look worse than the last. If NVIDIA's revenue merely grows at 20%, still remarkable, the PE collapses to 15. 15 times current earnings is a stock worth $2.1 trillion. That is a 60% drawdown from here. And at $2.1 trillion, NVIDIA would still be the third most valuable company on Earth. Still expensive. The Cisco scenario is an 86% drawdown. NVIDIA at $750 billion. In 26 years, just like Cisco, it might never see $5 trillion again. So is NVIDIA a bad company? No. Is the technology transformative? Absolutely. The question is whether the stock price reflects the business or reflects a closed loop. Cisco was a great company in 2002. Its stock just spent 26 years proving great company and great stock at this price are not the same sentence. Hit subscribe, and we'll keep telling you the stories Wall Street is too polite to tell. It's not a question of if. It's whose pension is on the wrong side of it. Cheers.